Just look at FY26 performance of India's leading gold retail companies. Kalyan jeweler revenue has jumped 42% in FY26 and profits have nearly doubled from 700 to 1350 crore. Yet, its stock price has tanked more than 40%. In fact, its stock is down more than 50% from January 25 high. Then look at Gadgil. In FY26, it has reported around 42% revenue growth and profits have nearly doubled from 218 to 410 crore. Yet, it has generated no return in last 1 year and overall its stock is down 30% from listing price. Then look at Senco Gold. In FY26, it has delivered around 33% revenue growth and profits have jumped 260% from 159 to 574 crore. Yet there is no return in last 1 year and overall Senco is down more than 50% from all-time high. The only gold retail company that has not fallen, in fact it has done well, is Titan, and stock price is up around 20% in last 1 year. The big question is, if business is doing well, why are stock prices falling? Interestingly, since the earning growth has been high but stock has not delivered return, these gold retailers have witnessed sharp fall in valuation. Kalyan PE ratio has fallen from highs of 120 to now below 30. Gadgil PE has fallen from highs of around 60 to now below 20. Senco PE has fallen from highs of around 55 to now below 10. Now these same gold retailers were market darling between 22 to 24 period. Kalyan jeweler share price had jumped 10 times between June 22 to Jan 25. Senco was up more than 3.5 times. Gadgil got listed in September 24 at 73% premium. So now what went wrong with these gold retailers? And most important, now that the valuations have fallen significantly, are they a good counterbet for FY27? Alright, let's discuss it. So the first reason behind the correction in gold retailers despite strong FY26 performance is the movement in gold prices itself. Over the last few years, gold has witnessed one of the strongest rally in its history. In 2023, gold was trading at around 50,000 per 10 gram and today it has moved above 1.5 lakh rupees per 10 gram. Now understand this. Since gold prices have jumped significantly, even if a jewelry retailer sells the same quantity of gold, the revenue would automatically rise because the underlying gold prices itself has jumped. And this is where investors have started becoming cautious. In FY26, Kalyan, Gadgil and Senco have reported around 35 to 45% revenue growth. But the question is, how much of this growth is coming from jewelry volume and how much is simply coming from increase in gold prices? In fact, in FY26, gold prices have increased by around 60 to 70%. So it looks like volume growth was weak for gold companies in FY26. The reason is because in India, people have a specific budget to purchase gold. So let's say a person has a budget of 5 lakh and earlier gold was at 50,000 per 10 gram, you would get 100 gram of gold. Now that the gold prices have jumped to 1.5 lakh per 10 gram, you would get only 33 gram of gold. So it's not like if the gold prices have jumped 3 times, people will increase their budget by 3 times. So obviously in that case, the volume would fall. And now gold prices are consolidating. In fact, there's some correction. So the concern is, if gold price consolidate in FY27 and volume growth remain moderate because the prices are still high, can gold retailer still maintain earning growth of 25 to 30% annually? Then second concern is affordability. There's no doubt that gold occupies a special place in Indian culture. Whether it's wedding, festivals, religious occasion, Indians have traditionally viewed gold as both jewelry and a store of wealth. However, the sharp rise in gold prices have increased the cost of ownership. A family that would comfortably buy a certain quantity of gold a few years ago may now have to reduce the quantity purchase or postpone this discretionary purchase altogether. Wedding demand is likely to remain resilient, but impulse purchases and non-essential purchases would become much more sensitive to price. On top of that, recently India's Prime Minister has appealed to Indians to stop buying gold for next 1 year unless it is essential, and people take him seriously. Not only that, government has also increased import duty on gold from 6% to 15%. So gold is now even more costlier. Then another problem is India is already facing a high inflation problem due to sharp increase in crude oil prices. So all these factors would create negative sentiment and gold spending can reduce. Then third reason is valuation normalization. During 24 and early 25, Indian equities were in a strong bull market and investors were paying extremely high valuation. Kalyan Jeweler traded at more than 100 times earning. Senco and PN Gadgil were also commanding premium valuation that assumed several years of extraordinary growth. The problem with such high valuation is that companies don't just need to perform well, they need to continuously exceed the expectation. Today, Kalyan PE has fallen from above 100 to below 30. PN Gadgil valuation has compressed significantly, and Senco now trades at fraction of its peak multiple. In other words, the market is now questioning whether the extraordinary growth of last few years can continue in the same pace in the future or not. Now let's look at the opportunity and risk for gold retailers in FY27 and beyond. Let's separate the near-term outlook and medium-term outlook for gold retailer. Now let's first look at the near-term outlook. So frankly speaking, the near-term environment does appear challenging for gold retailer. The biggest issue is affordability. Then second challenge is, if gold price consolidate, growth rate could moderate. And third challenge is sentiment. Today, the sentiment for gold retail sector are very weak. Now, as far as specific guidance for FY27 is concerned, Kalyan did not provide specific guidance, but it's planned to open 150 new showroom across its Kalyan, Candare and new regional brand format. Also, they guided that same store sales growth that was very high at 20-30% in last 2-3 years, and it would be 10% for the next 3 to 5 years. So that's a lower growth guidance. PN Gadgil management has provided explicit revenue guidance of 13,500 crore with EBITDA margin of 7 to 7.5% and PAT margin of 4%. That translates to net profit of 540 crore. Please note that company's FY26 profit was 410 crore. So in FY27, if PN Gadgil is able to grow as per management guidance, then its earning can grow by around 30%. Senco on the other side has provided minimum 20% revenue growth in FY27 with 7.5% EBITDA and 4.5% PAT. That translates to around 380 crore PAT. Mind you, company's PAT for FY26 was 574 crore, mainly due to sharp margin expansion from 6% to 11%. And margins expanded mainly due to inventory gain. Because when gold prices rise sharply, inventory purchased earlier at lower price gets sold out at higher price. But now Senco has guided for 7.5% EBITDA in FY27 versus 11% in FY26. So going forward, Senco net profit can degrow in FY27. So this is near-term guidance for FY27. But what about medium to long-term growth potential? So the biggest growth driver for gold retail companies like Titan, Kalyan, PN Gadgil and Senco is continuous shift from unorganized to organized retail. So let's spend some time to understand why it is such a massive trend. First reason is trust. Organized gold retail chains can be trusted for gold purity. They also offer BIS hallmarking, which provides transparency. Then organized gold retailers are very transparent in terms of making charges. So customers know what they are paying for. Another major factor is organized retailers offer clear buyback, exchange and upgrade program. So customers know exactly how their old jewelry will be valued in the future. This creates confidence and encourages repeat purchase. Then organized gold retailers offer much better product design as compared to local jewelry shop. Then organized retailer offer gold saving scheme, EMI option and digital payment facility that make purchase more convenient. And finally, the biggest reason is branding. When you spend a significant amount of money, you feel more comfortable buying from a company that you can recognize. In fact, Titan is now targeting different categories with multiple brands within the same house. Tanishq is the flagship brand that targets the mainstream premium jewelry market. Then it offers Mia by Tanishq that targets working women, self-purchase jewelry and everyday wear. Then CaratLane is targeting younger consumer and first-time jewelry buyer. Then Kalyan also acquired Candare, which it acquired, and scaling it up as an online first jewelry platform. Candare is somewhat similar to what CaratLane is for Titan. PN Gadgil Jewelers has also building PN Gargi as a separate brand. The idea is somewhat similar to what Mia or CaratLane does in terms of targeting younger customer. So these organized gold retailers are now targeting different consumers with multi-brand strategies, which is not possible for a local gold owner. This is why the organized retail story remains so powerful. Then another important factor is financing and inventory management. Gold retailing is a highly working capital intensive business. As gold prices rise, maintaining inventory becomes increasingly expensive. Large organized retail typically have better access to financing, gold metal loans and supply relationship. Smaller jewelers often find it more difficult to manage working capital requirement when gold prices rise sharply. This creates another competitive advantage for organized player. So I hope you got a good idea on why organized players are capturing gold market in India. But despite all these factors, the fact remains that gold prices have jumped significantly and it can impact the demand. So how does gold retail companies ensure that the demand remains robust? So if you go through the latest con calls, all gold retail companies are focusing on changing the product mix. First, they are focusing on studded jewelry, diamond jewelry, precious stone and uncut jewelry. In these products, gold is the only one component of final selling price. It includes your designs, craftsmanship, diamonds and gemstone that contribute a meaningful portion of the value. As a result, the customer focus less on absolute gold content and more on the overall product. This allows retailers to maintain healthy ticket size while also reducing their dependence on pure gold weight. Then second shift is towards lower carat jewelry. Traditionally, Indian consumers preferred 22 carat jewelry. However, many retailers are now promoting 18 carat and even 14 carat jewelry, especially among young customers. Since these products contain less pure gold, they are more affordable while still offering attractive design and aesthetics. This helps customers continue purchasing jewelry despite sharp increase in gold prices. Please note that studded jewelry, diamond jewelry and low carat products typically carry higher margin than plain pure gold. Therefore, even if gold prices remains elevated, retailers can protect their profitability by increasing share of these categories in their sales mix. I hope you got a good idea on why gold retail companies have underperformed in last 18 months in spite of excellent revenue and profit growth, and what can be the expectation in near to mid-term. Now it takes us to the final question. What should you do with gold retail companies? Buy, sell or hold? Let's discuss it. So the answer totally depends on your time horizon. In the near term, the concerns are real. Gold prices have risen sharply, affordability has become a challenge, import duties have increased, volume growth appears weak, and FY26 earnings have benefited from inventory gain, which may not be the case in FY27. Therefore, it would not be surprising if these stocks remain volatile over the next few quarters. However, if you look beyond FY27, the investment case becomes more interesting. Valuations have corrected sharply, where Kalyan PE has fallen from over 100 to below 30, PN Gadgil has derated significantly, Senco now trades at single-digit earning multiples. Yet, the long-term drivers like organized market share gain, store expansion, premiumization, and India's love for gold remains largely intact. So in my opinion, the risk rewards looks much more favorable today. Hence, gold retail companies can be a good contra bet. Whether they turn into wealth creator or value trap will largely depend on one thing. Can they continue growing volumes and market share in a world where gold has become significantly more expensive? I believe that gold retail companies have a long runway of growth in India, and current valuations have already factored in the negative impact of FY27. Hence, if you are looking to build a long-term portfolio and do not have exposure in gold retail companies, you can consider having some exposure in a systematic manner. But be mentally prepared to face volatility in FY27. Okay, let me not stress this video further. Now, I would love to know your thought on gold companies. Do you think it is a good time to consider buying or better to avoid them for now? And which is your preferred gold retailer? If you find this video useful, do share it within your circle. I'll see you next video. Till then, take care.